I'm John Generone, Editor-in-Chief of IPO Edge. Very happy to be back at Nasdaq Market Site. Today we are here with Raj Imteaz of ICR Capital, where he's the head of Convertibles and Equity Derivative Advisory. Raj, thanks for joining the program.
Thank you for having me, John.
So, Raj, before we get into the questions I was going to ask, you and I were just chatting in the green room. We both started our careers right around the corner here. I was at Morgan Stanley, you were at Barclays, you were in Converts, I was in the debt floor. Here we are, thrilled to be seeing you here back in Times Square. So, Raj, tell us a bit about what's going on with convertibles. Everyone's talking about the IPO market coming back to life, but it looks to me like convertibles are booming.
Oh, absolutely. Issuance volume this year has been 50 billion already. To put things in perspective, in the prior 2 years, full year issuance on average was a little bit north of 40. And as you can imagine, it's mostly driven by rates. Lots of companies need to refi their high cost debt. If you're a high yield issuer, you were funding at 4 or 5% before. Now it's 7-8%. Even investment grade companies, 2.5-3% is now 5-6%. You had some unhedged term loan on your balance sheet, SOFR plus 50 basis points. You thought you would pay 3%, you're paying 6%. So how else are you going to reduce your interest rate if you don't come to the convert market? So super exciting times.
Interesting. Now, who are the end buyers? Are these convert funds that are buying most of these, or is it an array of different investors?
For sure, convert funds, and some of them are hedge funds, some of them are dedicated convertible funds, and the investors there, they want equity-like upside or quasi-equity upside, but with the downside protection of a bond floor. And then sometimes credit funds buy convertibles, equity and income funds buy convertibles. Yeah, it's a pretty large asset class, 250-300 billion AUM in the US.
Wow. Now, is it sector specific? Are there hot sectors that are working better than others, or is it pretty diverse?
Pretty diverse, although if you go back, I mean, for 10, 20, 30 years, tech and healthcare have always been two of the busiest sectors. And I'll tell you a story. Converts were used to partially fund the railroad boom in the 1850s. So converts were always this driver of high growth companies financing. So we always see that, but then what's also changing is because of higher interest rates, we're seeing more rated companies coming to the market, more investment grade companies coming to the market, and they're not always tech and healthcare. So if you look at, for example, last year and a half, 20 billion plus of utility deals have come to our market at a rate of kind of 140-50% higher issuance rate than prior years for that sector. We have advised on $6-7 billion worth of deals, and you have Uber, Supermicro, Xerox, Itron, you have Repay. It's all over the map, so all sorts of companies, and we think it's good for the market. I mean, in 2020, 2021, you saw a lot of tech companies, software companies coming to our market, and that made the convert investor portfolios a little unbalanced. So it's good to have a diverse range of issuers coming to our market.
Great. Now, Raj, one thing we always talk about inevitably when we're discussing the IPO market is interest rates. Now, with converts, Chairman Powell is talking about, he's flagging increasingly cuts on the horizon. How does that impact your world?
Yeah, so what's interesting is sometimes people may say, so we think rates will go down, so I'll just wait.
Yeah.
Well, if you look at the Fed futures market, there's a 98.4% probability already baked in that there will be 2 or more rate cuts by the end of this year. 66+% probability of 3 or more rate cuts. If you look at the 5-year SOFR, which is kind of, think of it as average expected 5-year SOFR rates, it has come down about 25-30 basis points in the last 1 month. So the market is already baking in that rate cut. And equity markets too. If you look at, for example, mid-cap companies, a lot of them have done well in the last month or so. So if your view is rates will go down, I'm going to wait. Well, no, that has already been baked in.
Right.
So now your question is, well, no, but my view is rates will go to 0. Well, if that's the case, then sure, you should wait. But if that happens, probably then growth stock valuations will shoot up. and there'll be a wave of issuance from there. So if you're asking me whether I'm worried that rates will go down and therefore people will have lower cost of debt and therefore converts will be less attractive, not super worried. I think the next few years we have a pretty nice tailwind going in, and we'll have continuous issuance volume.
Great. Now I've got kind of a funny question for you. Who should not be issuing a convertible? Is there category companies for which this doesn't make sense?
Yeah, so I'll answer the question in a slightly different way.
Yeah.
So what are the negatives of convertibles, right? I love converts. I've done this for 20 years. There are lots of positives, but there are a number of negatives, and some of them are real, some of them are perceived, some of them are small, some of them are large. There are three large negatives. Converts can be dilutive. You are not just issuing debt, you're issuing debt plus option. And if your view is that stock is going to be 5x, no matter what structural enhancement you use to protect that dilution, share buyback, a capped call hedge, net share settlement, meaning paying down the principal amount in cash, I won't be able to save you from that dilution, from that 5x level. Now, so that means if you're not very happy with your stock, but you think stock is going to be 5x, don't do a convert. Here is one interesting thought for you, though. If you think your stock is going to be 5x, you're probably a high growth issuer, probably don't have very good access to the debt markets, therefore you're comparing a convert to equity. Well, my product will always be better than equity in terms of dilution if stock is 5x. Right. Who else? If you don't like debt, a convert at the end of the day is debt. It's viewed as debt, 100% debt by rating agencies. It's debt on the balance sheet. You have to repay it if stock doesn't perform, and even if stock performs, depending on the structure, you have to repay the principal amount. If you don't like debt, if you think your balance sheet cannot handle debt, don't do a convert. The last point is not I wouldn't say that don't do it, but it's something you have to keep a very keen eye on. On the day of the convertible marketing, stock tends to go down because part of the investor base in the convert market, they hedged out the equity risk by shorting shares. And there are ways to mitigate that partially or even fully if you do a share buyback. But if you don't use one or two of those stock price impact mitigation strategies, stock will go down. And it's not for a nefarious reason, it's a hedging strategy. But if you don't like that, let's talk about it, and if you can't live with that risk, then maybe converts are not for you. And then there are some edge cases, John. A company doesn't have the right stock technicals to do a convert. In that case, unless you really, really need capital, why do something unnatural?
Gotcha. All right, Raj, last question. We talk a lot around here about IPO readiness. Tell me about convert readiness. Is it similar?
Similar in the sense that the earlier you start preparing, the better. Yeah. And I'll tell you something. Converts are a unique beast. Why? Let's say you're the CFO of a mid-cap company, and you said, Raj, I want to go raise $500 million next week. I'm not rated. I don't have a shelf up. I just want to do a deal next week. I can get you $500 million next week. It's fast. And they're covenant-free, generally structurally pretty issuer-friendly. However, you have to keep a keen eye on the structure to make sure you get the best deal done. How do you do that? Start ahead of time. Yes, we can get a deal done next week, but as you think about, let's say today we said, let's have an org call, you will get questions. What settlement method do you want? Do you want a hedge structure? What flavor of the hedge structure? And if you can spend time with us and your lead bank ahead of time to have the right answers to those, you understand what the pluses and minuses are, you are way ahead of your peers and competitors. I mean, I'll tell you that clients that prepare ahead of time and educate themselves ahead of time, they get far better deals than others. In fact, I'll go so far as to say that if I could create an ETF of clients that are prepared versus clients that don't spend time on these,
Yeah.
I can guarantee you that the first group will outperform the second group, right? And think about other things internally. You want to socialize the idea with one or two board members. You don't want to spring this on the board at the last minute and say, I want to do a convert. So there's a lot of value. I understand our CFO and treasurer clients, they're extremely busy people, but spending a few hours ahead of time, understanding the key pluses, minuses, the decision points, spending time on those will help these clients go to the market faster and get really good deals.
Well, Raj, this has been super insightful. A little lesson here in convertibles. I was delighted to have you here at Nasdaq. We're going to leave it there. I'm John Janarone, Editor-in-Chief of IPO Edge, signing off.